Hi, I'm Jimmy. In this video, we're going to walk through 8 different tips and tricks that we can use to identify the early red flags for possible fraud in the making. So in a recent video I did where we looked at the fraud accusations on General Electric, well, it hit me that it might make sense to go through some of the different ways that we could try to notice strange things that a company's management team might do that could eventually lead to a full-blown fraud. Okay, let's kick it off. So let's imagine we had a scale that looks something like this. All the way at the top is the highest quality companies out there. And then all the way down here at the bottom, you have companies that are straight up committing fraud. Now, generally, companies don't start as frauds. Usually what happens is they start somewhere up in the green area, and then something goes wrong and they gradually adjust things, slowly compromising the business until they eventually end up in the situation where they are a full-blown fraud. So first, we're going to look quickly at this scale, and then we're going to touch on some ways that we can identify where a company is on this scale and which direction they're heading. Are they getting better or are they getting worse? So there are a couple factors that help us determine where on the scale a company might stand. First, do they follow the rules of either IFRS or US GAAP? That's the accounting standards both in the US and internationally. Then, in their financial reporting section, in their financial reports, do they give us the information that we need to make good decisions? Are they unbiased in their accounting choices? Are they fully disclosing everything? Are they transparent? Things like that. Then we have earnings quality. Now, earnings quality refers to profits that are the profits real? Are they sustainable? And can they keep the company growing? And will they provide enough additional capital to return to us investors? Okay, simple enough. Now, if we go ahead and fill in this whole table, we can see what this looks like. So the key to understanding how fraud could happen and also how this scale works is for us to realize that within a company's financial statements and within the rules of accounting, there are usually choices. These choices are usually necessary since there are so many different types of businesses, and in theory, the company should make the choice that is most appropriate for their business. But sometimes companies can make choices that make their financial statements look better than they really are. Ultimately, that's what we're trying to identify. It's also how this scale works. So the ideal company, well, this is the highest quality company. Well, of course, they follow the accounting rules, and they also give us all the information we need to make good investment decisions. They're very transparent about what they do. They also have high quality earnings. But as we slide down to the next level, well, maybe the next level is still a very solid company, but they're just not quite as transparent. And because they lack a little bit of transparency, well, in theory, their earnings quality is just a little bit lower because of some things we don't know. Then down here, well, here the company is starting to get a little bit tricky. Maybe some of their choices are still within the rules of accounting, but perhaps they're just a little bit biased in some situations. Yes, they're still following the rules, but we want to recognize that maybe their numbers are a bit biased. Then if we move down to the next level, well, now they're really starting to get now management, they're still following the rules, but things are not looking that great because now they're really starting to manage earnings or manage revenue or whatever it might be. But they're still following the rules. Well, then we drop into the fraud zone, and here we have groups that are no longer following the accounting rules. This is where Enron would land. Then the bottom level, well, that's just straight up fraud. In Enron's situation, what they did was they had a business. They were actually doing things, but they lied. They just didn't follow the rules of accounting. In Bernie Madoff's case, well, it was just straight up fraud. They just made up numbers. Okay, so now we're on to our 8-item checklist for identifying fraud red flags. First, we'll start with revenue. And although revenue might seem to be fairly straightforward, there's actually a lot that a company can do that could be considered biased or even suspicious. So when we start our research, we're going to assume that a company is all the way up here. We're going to assume they're a high quality company. But as we go through our analysis, well, we may come across a company that is smoothing earnings or actively managing revenue. So this is actually the first item on the checklist, and that is look for a company that makes changes to their revenue recognition policy. Generally, the company will, if they do change the method that they're accounting for revenue, well, they're going to talk about that usually fairly extensively in either the earnings call, the earnings release, the 10K, the 10Q, something like that. And oftentimes it's perfectly fine. But sometimes we're going to notice that there's not a lot of disclosure as to why they did it or how things are impacted. And to me, that's the real red flag. If they change things and they don't really explain it, they just quickly gloss over, yeah, we made a change, and then they move on because they're required by rule to say that they made a change, but how much they explain it could be all the difference in the world. Okay, next on the checklist is a receivables turnover number that continues to fall. So to calculate receivables turnover, well, we take revenue and we divide that by the average number of receivables. So this is how much the company expects to collect from its customers. And to get the average receivables, basically we take the receivables from the end of the period and the beginning of the period, we add them up, divide by 2, take the average number. So what does receivables turnover tell us? Well, receivables are how much the customer owes the company. And if receivables got larger, well, then receivables turnover would get smaller. So if receivables turnover is consistently getting smaller, well, it's possible that the company is getting more lenient with their credit policy with their customers. So if we were to see, let's pretend we see sales rising and receivables turnover getting smaller, well, maybe sales are only rising because the company is offering better financing terms. So back on our scale here, well, if that's what they're doing, that would lead to a falling earnings quality, which would move them down our scale. Okay, next on our checklist is inventory turnover, which is actually very similar to receivables turnover, except this time we take cost of goods sold and divide it by average inventory. So if we're consistently seeing falling inventory turnover, well, this could be a sign that management is doing a poor job of managing the inventory. And this is another good example of falling earnings quality, which is a good thing for us to recognize. The next thing that we could watch for that could be an indication of management playing with numbers a bit is something called Lifo Liquidation. So Lifo stands for last in, first out. And it's a way for a company to account for their inventories. Now, this is only allowed in the US under US GAAP, so this wouldn't apply to companies that follow IFRS. But let's imagine that we're analyzing a lumber company, and they cut down the lumber, they throw it in a pile, and that lumber costs them $10 each. Well, they go ahead and they sell that for $15. Okay, they don't quite sell all of it, so they only sell out of the 100 units that they produce, they only sell, let's say, 90 of them. Next year, they do it again, produce 100, sell 90 of them, except this time they produced it for $11, they sell it for $16. Then 12, and they sell it for 17 in the following year. Well, in the fourth year, the company realizes that they now have 40 units on hand at a cheaper cost basis. So this year, what the company does is they produce only, let's say, 50 units. They sell all 90 units again, but the first 10 are at $10, the second 10 are at $11, the third 10 are at $12, and what you end up with is much better looking margins because you're selling them all for $18 per item. That's called a Lifo liquidation, and if management doesn't go out of their way to explain what they did and why their margins got better, that could be a real problem, and that would be a good indication of a lack of disclosure, and that would make them slide down our scale. Now, it's not necessarily a negative thing. Companies do this. They have that inventory. They're going to have to get rid of it. The key to the whole thing is disclosures. Do they properly explain what it is up front and center and why, in theory, their margins got better? But if they try to hide it at all, well, clearly, it's untrue that their margins just got better due to some improved business method, and that could be a problem for the company going forward. Okay, next we have operating cash flow to net income consistently being less than 1. So if we think about operating cash flow, well, this is how much cash a company brings in. So if we take in that cash and we divide it by the net income, then what we end up with is operating cash flow to net income. Now, if both numbers were the same, the ratio would end up being 1. But let's imagine that one time a company extended credit to a customer and that customer is yet to pay. So you have net income, that company brought in that revenue, they account for it, but cash flow doesn't go up. In theory, you would expect for the next period to include that cash that the customer would have since paid then, and the two numbers should about average out to be somewhere near 1. But if the company doesn't pay and the number stays consistently below 1, this could be an indication that the company is somehow manipulating earnings without bringing in cash, which cash often is fairly verifiable by auditors. So they might be a bit more hesitant to mess with the cash, before they're willing to mess with profits. Okay, now we're on to the final couple pieces, and here we compare our company to its competitors. There are 3 different pieces: seasonality, capitalizing costs, and depreciation methods. So seasonality is important to recognize in an industry. For example, maybe maybe in the toy industry, their fourth quarter is very strong. Well, one company has a pretty decent fourth quarter, but not a great one like all the other companies are having that are in the same industry. But then their first quarter is far and away better than everybody else's. That might make us question, is management doing something to somehow kick revenue from the fourth quarter over to the first quarter? And this would be a good example of smoothing earnings and messing with the revenue recognition numbers. Then we have capitalizing costs and depreciation methods. So every company has a choice of how they're going to account for the assets that they have. If they expense them, it just goes in the income statement, reduces profits, profits end up smaller. If you capitalize an expense, well, what would happen was that would go on the balance sheet as an asset, and then you gradually expense that through depreciation. So in theory, it would make this period's profit look bigger. Now, if everybody in the industry isn't doing that and our company is, that could end up being a problem. Along those same lines is depreciation. If every company in a particular industry is buying trucks, and when they buy those trucks, they're all buying the same truck and they're all depreciating it over 5 years. But for some reason, the company we're analyzing it is depreciating it. They're going to depreciate it over 10 years. Well, if they're doing that, the depreciation expense would be spread out more, so it would be smaller each year. In theory, it would look like they have bigger profits because they would be taking a smaller expense. So it's important to compare depreciation methods and what they capitalize and what they don't, to other competitors to see if that's normally the way the industry does it, because every industry is a little bit different. So those are the top 8 things that we can use to identify red flags in accounting that could eventually lead to fraud. When we're jumping over to our scale here, well, we don't want to see a company sliding down, slowly getting less transparent on what they're doing, a lower quality of earnings. We want to avoid that. And it might make sense for us to only limit ourselves to companies that stay in the top, let's say the top 2. But there are many different ways outside of the 8 that I've named here. Are there any that you would have included on this list that I didn't include? Please let me know what you think in the comments below. If you haven't done so yet, hit the thumbs up, hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.